Some of you may have heard of REITs, and many Singaporeans tend to like them because of the dividends that they pay out. And actually, if you ask those people that invest in REITs, they tell you it's actually quite a safe investment. So in this video, we're going to explore whether that is true, what makes them an attractive investment opportunity, and whether or not I have any in my portfolio. So Singaporeans tend to like REITs, right? Because they actually have to distribute a minimum 90% of their earnings to investors, and these usually come in the form of dividends, which is why I say Singaporeans like to buy REITs for dividends. And the second thing that not many people know is that for Singapore REITs, right, 75% of their total assets need to be in income-producing assets. What this means is for every 4 properties they buy, 3 of them need to be income-producing. So although it sounds safe, right, the risk is, however, in management's ability to pick good properties that give you good rental yields. Otherwise, you give you 90% of a rental use, also no use. Right? So REITs basically, right, they pool the investors' money together and then they actually go and buy properties. And so different REITs actually have different investment strategies. Some of them buy buildings from retail, commercial, logistics. Some go into hospitality, medical center, and data centers. And some of the REITs actually even hold properties overseas. So it really depends on what you're looking for. How it works, right, is after you buy shares of these REITs, they take your money and then they go and buy these properties. These properties that they buy, they'll go and rent out. And after they collect the rent, they'll actually distribute the rent back to you as dividends. And this cycle goes on until such a time where they feel like, hey, maybe this property is a good time to sell, and then they'll sell off the property and then they'll also return the earnings to you. So for REITs that are doing well, right, you should actually see the dividends increase over time, and at the same time also experience some capital appreciation. But because you see the main focus of REITs is to generate an income for you, the capital appreciation here might be a little bit slow. Now, if you were to consider this very popular Singapore REIT, Mapletree Industrial Trust, just looking at the share price alone, right, over the last 5 years, the share price barely moved. From 2019, right, it was $2.09 to today, it's actually $2.30. However, if you look at the dividends payout, back in 2019, this was paying out about 12 cents per share, and today it's paying out 13.6 cents a share. Now, what does that mean for you? Back in 2019, let's say you purchased this REIT and it was paying you $10,000 in dividends. Over the last 5 years, by not investing a single cent, your dividend will have just automatically went up from $10,000 a year to $11,500 a year. And so generally, right, people buy REITs for 2 reasons. The first one, right, is because they are able to actually generate a pretty stable 4 to 5% dividend yield, which are better than bonds and fixed deposits. I know right now, bonds and fixed deposits, the yields seem very high, but if you look at history, and history were to tell us anything, is that the interest rate will not stay so high for so long. And so when that happens, you need to slowly find other ways of making your money work for you. And so the second reason why people buy REITs, right, is a form of diversification to their portfolio, because the price of REITs don't exactly move in correlation to the stock market. So by having some REITs in your portfolio, it actually lessens the volatility for you. And so to me, right, the first and most important thing when investing in a REIT is not to go and chase after high dividend yield, because there are many ways that a company can give you a high dividend yield, but the most important thing is whether or not that is sustainable and whether or not the company is taking on too much risk just to give you that high dividend yield. For me personally, right, when I look at REITs, I look for 5 things. The first thing I look for is that the dividends are increasing. And then after that, I look at whether or not I'm comfortable with how much debt the company is using, whether or not their occupancy rates are high, and whether or not they have a diversified holdings of properties. But I think one of the things that a lot of people tend to miss out, which I like to look for, is basically when the lease of these properties expire. Now, what do I mean? I give you an example. If let's say today I'm holding 10 properties, 8 of them, the bank loan, I have to refinance it this year. Means I have to take on a new loan. You imagine the interest rates this year. So high, right? What does that mean? That means my expense become higher. I have to pay more mortgage to sustain these properties. And so if you put that back into the context of a REIT, what this means is that the more they have to pay back the bank as mortgage, the less money they can actually pay to you as an investor as dividends. A very popular way of investing in REITs, right, is just to put in a fixed amount over time and slowly grow your retirement portfolio that way. And because as the dividends increase over time, you can slowly live off the dividends in future. And I think that is a very safe and stable way of growing your investment portfolio. But actually, I would argue that is not the best way to grow your investment portfolio, because that is how I started, safe, stable, and the consistent stream of income was actually very good. But halfway through, I realized the math doesn't math for me. Okay? And so I'm going to explain this in a little bit. So what I'm trying to say, right, is for the 5% dividend to actually be able to support your lifestyle, you need to have a large capital. Even with about $500,000 invested into REITs, right, at a 5% dividend, that means you receive about 25k a year or 2k a month. Now, for a couple living in Singapore, and if you account for inflation and all that, whether or not 2k a month is sufficient is really a big question mark. So personally, for me right now, my focus is on capital appreciation, and because of my long-time horizon, I feel very comfortable having 100% of my capital allocated into things like index funds and stocks. So over this period of time, when I'm still working, I don't need the income that REITs generate. I allow my capital to grow so that when I do decide to retire, right, I have a larger capital to put into into REITs, and at that point in time, hopefully the 5% dividends generated from REITs will be able to better support my retirement lifestyle. Which is why when I started investing, right, I actually started with this particular type of investment, and I speak more about it in this video over here.